Hello, everybody. So this is my second video today. I decided to go ahead and do this one right away because it is an important topic that I hope everybody will watch this, all my clients. We're going to talk about pass-through entity tax, which means your corporation, your business is going to pay tax at the state level. Um, so quick history on this. Back in 2017, when Trump passed his tax act, he did a very big overhaul on the tax system. Well, one of the things that they did was they limited what's called SALT taxes or state income taxes. So they limited state, or not just state income, state taxes in general. Like, so it used to be that when you could use itemized deductions, you can deduct medical expenses, property taxes, state income taxes, interest on a mortgage, and a few other things, right? Well, for Trump's tax act that was passed, they combine all taxes paid at state and local levels. So that would be your property tax, local city tax, income tax, or state income tax. And they said that is limited to $10,000. So people who live in large homes or states that have higher property taxes instantly got limited. Plus, if you had state income taxes, then that got limited as well. So what a lot of the states started doing is they started passing laws called pass-through entity tax, with the idea that your business would be taxed more like a traditional corporation at the state levels. And they did this because state taxes are a deductible expense on a business for federal income tax purposes. So then they basically, what they did is they circumvented the federal law by limiting state taxes by making state taxes now a business expense. And so what happens is basically when you file your pass-through entity, which is a partnership or an S corporation, when you file that business tax return, you now are required to pay corporate, or what we call pass-through entity tax at the state level. Your business pays that tax. So that's kind of the quick history of it. So what is it and how does it affect us? So this really doesn't affect most of my clients very much. This because ultimately we move as much of your property taxes onto the business as much as possible anyway through the home office deduction. So this really wasn't a big deal. And most of the state income taxes are pretty immaterial. They're not going to result in a whole lot of savings at the federal level. So what we've always done in order to try to simplify things in the past was elect out of the pass-through entity tax so that all income tax is still calculated on your individual level instead of on the business. Well, I guess that created confusion for people and for states. And a lot of the states have now passed laws where you're not allowed to elect out of it anymore. I'm starting to see that as I go through corporate tax returns, that we're no longer allowed to elect out of it in most of the states. So going forward, you're going to have what is called pass-through entity tax. Basically, your business is going to be taxed like a traditional corporation at the state level. So what happens, just a quick overview, when we file a corporate tax return, a pass-through entity S corporation tax return on a partnership, at the federal level, no tax is owed. All the income passes to you individually. I've done another video on this if you have questions about it, how S corporations are taxed. But anyway, income passes from the business to you personally, where taxes are calculated and you pay taxes at the individual level on your personal tax return for federal taxes. For state taxes, what's going to happen is you're going to calculate the tax and you're going to pay it as a corporation. So this can be difficult to understand because we are single member LLCs and we kind of get this idea that we are our business. Well, in some ways you are, but legally you are not. Legally, your business and you are completely separate. And so what's happening is when your business is required to calculate and pay the state taxes, when you go to pay them, you have to make sure you pay them as your business. Because what's going to happen is your state has two accounts for you. It has a business account and it has your personal account. And if you go and pay that tax bill as you personally, that's basically like you paying somebody else's electric bill, or you paying somebody else's water bill, or somebody else's bill for them, is what's happening at the state level. You might not see it that way, but the state says, oh, look, this account just got paid, not this account. So what's going to happen is the corporate account is still going to be due. They're going to send collection letters at you, and they're going to charge interest. So when you pay the corporate pass-through entity tax, you have to pay it as your corporation using your business name, your business bank account or credit card, and using your business EIN, not your personal name or your social security number. You are not paying this, your business is paying this, and it is a business expense. Okay, how does this benefit us? So one, it means you're not going to owe taxes on your 1040 at the state level, or you shouldn't. Now, there's always going to be some calculation differences. You might get a real bit of a refund because the business paid too much. You might owe a little bit more because the business didn't pay enough. Like there's always calculation differences, but typically those are pretty immaterial. It's maybe a few $100 or whatever, right? But the other way it's going to benefit you is now we are going to create those state income taxes that just become business income taxes at the state level, which is tax deductible for federal taxes. So going forward in 2024, you will now have an additional business expense of state income taxes to lower your federal taxes. So it is going to have a small benefit. State taxes are typically under 10%. So if we look at it at a federal level, how immaterial this really is let's say your business made a $100,000 profit. That means you're going to owe somewhere between $5,000 to $10,000 in tax. Well, then that's going to be a $5,000 to $10,000 expense on the federal return next year. Well, if you're making a $100,000 profit, you're in about the 20% tax bracket. So it's going to save you $10,000 times 20%. It's going to save you about $2,000 in taxes. I mean, that's not like very immaterial, but in the big scheme of things, if you're having a $100,000 profit, $2,000 in tax savings, it's not immaterial, but it is not a huge benefit, right? Like, so it's all like, I mean, if we were to talk about this in lower numbers, I mean, the benefit would be like $20. If you're making $500,000, the benefit might be like $10,000. So it's all percentages. So when you're comparing it in percentages, yeah, it's more beneficial the more money you make, but in comparison, it's not necessarily fully beneficial. Like if you made $10,000 in profit, we're talking maybe what, $20 in tax savings. If we're talking $100,000, it's going to be about $2,000 in tax savings. And that's not exact either, right? Like that is definitely back of the napkin, pulling this out of air type numbers. But so it is going to have some benefit for you, but I can't emphasize it enough that you have to pay this as the corporation. We run into this issue a lot at local governments that tax their businesses this way. Because we have this idea that we are our business, and yes, we are, because the business wouldn't operate without us, but your business is legally separate from you. And so if you pay this tax as a person, you're going to still owe it. And what's going to happen is your personal account will have a credit on it, and your business account will be accruing interest, and you'll be getting sent to collections. So just make sure you pay this as a corporation or as your business. That is the biggest thing that you can do. Thank you. Hopefully this is helpful, and I really hope everybody watches this one.